The FTSE 100, or the Financial Times Stock Exchange Index 100, is a collection of the top 100 companies that are listed on the London Stock Exchange by the highest market capitalization. That basically means these top 100 companies have the most invested in them from their shareholders. And in this video, I'm going to do a deep dive into the FTSE 100 and tell you everything that you need to know as a beginner investor thinking about investing in the FTSE 100. So like I said, the FTSE 100 consists of the top 100 companies listed in the London Stock Exchange. So these are the top 100 UK based companies, and they tend to be the largest companies within the UK. So if we can see the graph of the original FTSE 100 index, we can see that it is given in points. However, when you invest with a stockbroker, for example Vanguard, you're going to be paying pounds, so therefore you're going to get a derivative of this index. So you're going to get something like maybe the Vanguard FTSE 100 or from iShares or whatever, and later in this video we're going to see the differences between those index funds because there will be some subtle differences. However, the original FTSE 100 index was created in 1984, so it's been a few decades and we have quite a bit of data on this index. If we go to the maximum view here on Google Finance, we can see the index movement over the total amount that the index was available for, starting at around 1,000 and today it stands at 7,000. That is around a 600% increase in those 40-ish so years. A 600% increase is basically 6xing your money, which means that if you put £1,000 at the beginning of this index into the FTSE 100 and did absolutely nothing to it, in today's value it would be worth around £6,000, not including the dividends. And that is something we're going to be talking about today because the FTSE 100 does pay a lot higher dividends than the S&P 500. If you haven't used Google Finance before, I would recommend using this because compared to just Google, this gives a lot more information. Also, it does give you the information to do with the bear markets. For example, if I click in the first crash, we can see that in 2001, the FTSE bowed to the pressure of the London shares, and then you can actually go to the article and find out more about that. You can see in 2008, during the financial crisis, it also went down. But we can see that compared to something like the S&P 500 over the past 40 years, the FTSE 100 index has yielded a lot less returns. Now, this could be due to a number of factors. One maybe being the fact that a lot of these companies are more dividend focused. They're less focused on growth per se. However, that is not the only reason. The other reason is that since the great financial crisis, the FTSE 100 and the UK economy hasn't been doing so well, where around 2008 it was one of the best economies in the world. Since then, a lot of things have happened, such as Brexit, which has made being based in the UK less desirable for many companies. That can lead to UK registered companies making less profit and also their international trades being affected. Furthermore, to add to that, the currency is getting weaker due to all sorts of economic factors, in addition to the fact that the US dollar is getting stronger for factors outside the control of the UK too. So with all those things considered, is the FTSE 100 worth putting your hard-earned money into? We can see that over the past 5 years, the index has almost stayed completely steady. We can see that in 2018, the price is almost exactly the same as it is today, but we have seen quite a few dips. So if you have been dollar cost averaging, you can see that if you're buying here and then you buy a lot here and here, you will be making a lot more return than it suggests here at 0.7%. That is the benefit of dollar cost averaging. I think the FTSE 100 shows it perfectly that dollar cost averaging is one of the best weapons you have against the stock market and actually building long-term wealth. You can see over the past year, the FTSE 100 has been doing pretty well, but the S&P 500 also over the past year has been doing pretty well. And this is a reflection that the previous year was one of the worst record years of the stock market. Year to date, 3% increase. Past 6 months, as you can see, 6% increase. So it's worth diving a bit deeper into what the FTSE 100 gives you exposure over, what kind of companies it invests into, and also what kind of sectors it has. And then we're going to go through the information packs and then compare some of the FTSE 100 funds. If you're curious about the app I'm using, this is called InvestEngine, and you can sign up free with the link in the description down below. So if we type in 100, we do actually get a few FTSE 100 funds. We can see that we have one from Invesco, one from iShares, and we should also have one from Vanguard, and that's the one I'm going to start with first. So because the FTSE 100 is considered as one of the benchmark indices, there are so many, I'm saying so many versions of the FTSE 100, especially for UK investors. But I'm going to go to the VUKE, so the VUKE from Vanguard, so the Vanguard FTSE 100. So this is one of the more popular FTSE 100 funds from Vanguard. Vanguard is a massive player in the index fund scene and they are one of the most trusted. However, if you use a platform like InvestEngine, you are actually paying exact same fees that Vanguard charges, less the platform fees that Vanguard charges, which is currently around 0.15% of your total holdings up to £250,000. With InvestEngine, however, there actually are no platform fees at the moment. So as you can see, the total expense ratio of this fund is 0.09%, so slightly more expensive than the S&P 500. 500. Most of these online brokers will not have the full 1984 data, however most of them do go up to 2016, but that should be enough to actually gauge the highs and lows. So we saw before the FTSE 100 was in terms of points, however the VUC from Vanguard is in pounds. The fund also mostly uses pounds. This is because they are mostly UK based companies. Even if they trade elsewhere, they're going to convert from the local currency into pounds and maybe into dollars and then pounds in some cases. So let's get into the breakdown of what this fund invests in to see what kind of companies you get exposure to by buying this index. So although it's called the FTSE 100, there are 139 holdings in this Vanguard fund. I'm guessing FTSE 139 will have less of a ring to it. So we can see the companies are organized by the amount of weighting they have in the fund. For example, the top one, which is Shell PLC, has a weighting of 9.1%. So that's a very high weighting overall in this fund. So Shell, as we know, is an energy company. Then we have AstraZeneca, Unilever, HSBC, BP, Diageo, British American Tobacco, Glencore, for example. These make up the majority of the FTSE 100. So AstraZeneca being a pharmaceutical company, Unilever being a products company. If you live in the UK, you would have inevitably bought something made by the Unilever group. Even if you don't live in the UK, you probably have some exposure to some of the products made by Unilever. HSBC is a big international bank. It's not just based in the UK. However, the FTSE 100 does give you exposure to that. BP is another oil and gas company. We have companies like GSK, which are pharmaceutical, Barclays, BAE Systems, which is a defense system, Vodafone, SSE, Tesco, NatWest, British Telecoms, Rolls-Royce, Next, Kingfisher PLC, so they own big companies like B&Q and Screwfix, Taylor Wimpey, JD Sports. Now if you look at the bottom, there are companies that the FTSE 100 has exposure over. For example, Tesla, Nvidia, Amazon, Alibaba. These are all non-UK based companies, most of them being in the United States of America. Even we have things like Netflix, Ferrari, really weird companies that are put into this index. Although these numbers are almost insignificant, less than 0.1%, it does give you a small amount of exposure to these companies, giving it a bit of diversity in just one index fund. Now if you wanted to, you can actually see what kind of companies fall under which sector. For example, if we wanted to see how much weighting this FTSE 100 has in terms of technology, because we know the S&P 500 is very weighted towards technology, we can see that there are around 15 holdings in technology, and if we add them up roughly in our head, this adds up to around 3% in total. So the FTSE 100 is mostly not very focused in technology, which is another reason why it didn't drop as much as the S&P 500 over the past 2 years. This is because the technology sector is one of the first to fall during recession-like times. So we have companies such as Vodafone, BT, Rightmove, Netflix, Shopify. So there's not actually that much in terms of technology exposure with the FTSE 100. If we're talking about the mining sector, the FTSE 100 is a lot higher in exposure to the mining sector than the technological sector. For example, we have over 13% weighting in the mining industry, with Shell falling under mining even though it does energy. However, Rio Tinto being a very big player in the mining industry, and companies such as Anglo American, Antofagasta, which I've never heard of, and Premier Oil. In terms of healthcare, again, it has more than 10% weighting in that, with exposure to two large companies such as AstraZeneca and GSK. In terms of financial, again, it does have a decent exposure to the financial industry, with Lloyds Banking Group, the London Stock Exchange Group, and companies such as Barclays, Aviva, Admiral, and Aiden. In terms of the industrial sector, we have exposure to companies such as British American Tobacco, BAE Systems, Smith & Nephew, and some small exposure to these companies. There is also some small exposure in terms of property with Segro and Land Securities Group. However, this adds up to a very small amount of the FTSE 100. So if we break down the regions the FTSE 100 is exposed to, we can see that it is not 100% or even 90% UK. Unlike ETFs that we have seen before, such as the S&P 500 and the Germany Vanguard All Cap, the FTSE 100 has around 80% exposure within the UK, 18% in Europe excluding UK, and very small amounts in North America, very small amounts in the emerging markets, and some in Asia. As you can see by weighting, it is highly exposed to mining and healthcare, and has medium exposure in the financial sector, industrial, consumer, and very small exposure to technology, energy, property, and then miscellaneous. So like I said before, the dividend yield of the FTSE 100 is significantly higher than the dividend yield of the S&P 500, with a dividend yield currently standing at around 4.0%. This is more than double the average S&P 500 fund, and the dividends are paid out quarterly with an annual equivalent of 4%. And if you let let your dividends compound, this 4% can really start to add up in 20-30 years, giving you a lot higher return than just looking at the growth numbers. Therefore, the FTSE 100 is very attractive to many investors, especially as you go closer to retirement and you can think of making a portfolio and living off that 4%. So like I also mentioned before, the FTSE 100 does have many different derivatives, with the VUC being one of the most common, but there are actually two main FTSE 100 funds from Vanguard, this being the VUC, and the main difference is the fact that this is a distributing fund, meaning that the dividends are paid out quarterly. However, there is a version of the FTSE 100 called the VUKG, also by Vanguard, which has the same total expense ratio of 0.09%. However, in terms of dividend, it is an accumulating fund, which automatically reinvests the dividends back into the index, and you won't actually receive those dividends in terms of cash payments. However, the growth of the company will be reflected by those dividends. It is important to note that an accumulating fund pays dividends, so if you have this outside of a stocks and shares ISA, you are still liable to pay tax on dividends in the way that you normally do. And if we go into the breakdown of these companies, you'll see that it is pretty much identical between the VUC and the VUKG. So in terms of the two Vanguard funds, these funds attempt to track the performance of the index by investing in all the constituent securities on the index in the same proportion as the original index. Where this is not possible, they will use a sampling process. The fund may use derivatives in order to reduce the risk or generate additional income. And the base currency of this fund, like I said before, is in the Great British Pounds. Also, like most index funds, the risk reward that Vanguard allocates to them is on the higher side of things, because such an index fund is not actually suitable for short-term investment. This is because the volatility of this index, along with most other index funds, are very volatile in the short term, which means that it can drop 30% maybe in a year, in a month, whatever it is. So all these funds are meant to be invested for the long term, because overall in the long term, if you invest consistently, you are going to be making a return based on historical facts. Although past indication is never an indication of future performance, and your capital is obviously always at risk when investing. That is why it is allocated a higher risk, 6 to 7. Something like government bonds might be 2 or 1, like a savings account will be something like a 1. So that's not something to really worry about. So if you're in it for the long run, a fund like the FTSE 100 should be good for you. So what if you don't like Vanguard for some reason, or you want to try out another fund? The FTSE 100 is offered by many other providers such as Invesco. They have the Invesco FTSE 100, ticker code S100. I hope that's not an OO, but it does look like an S100. That would make sense, FTSE 100. So as you can see, the price of this fund is a lot higher than the FTSE 100 from Vanguard. This doesn't really mean that you're going to get a lot more money in return. This just means the index has built up in a different way, because it tracks the FTSE 100 in slightly different ways. As you can see, the total expense ratio is as competitive with Vanguard, with being 0.09%. The fund is also an accumulating fund, meaning that the dividends are not paid out in cash, they're just reinvested back into the index. So if we go into breakdown, you can see that this fund, so this index, actually tracks the FTSE 100 in a slightly different way than the Vanguard one did. We have 145 holdings instead of 139, and now we can see Shell has a weighting of 7.4, so it's quite different, with biggest holdings being Shell, AstraZeneca, HSBC, Unilever, Diageo, GSK, BP, British American Tobacco. We can see in terms of the exposure to different regions, it does have exposure to UK slightly higher at 83% compared to around 80% for the Vanguard FTSE 100. It has exposure to also Europe at around 15%, excluding the UK, and very small exposure to other countries. So overall, if you're worried about exposure to different regions, the FTSE 100 from Vanguard will give you slight exposure to other regions, for example, more in North America, more in Europe, and even Asia. In terms of sectors, this fund is heavily concentrated in mining, healthcare, financial, and industrial, with medium exposure to consumer and technology, and small exposure to property, energy, and things that fall between them. If we go into the key investor information pack, we can see the risk again is 6, because all these index funds will have quite a high risk. In the short term, just like Vanguard, the fund will use derivatives if it needs, and also it does say that it might swap out some of the securities, meaning it can swap out the companies and not exactly follow the FTSE 100 index that we see at the beginning of the video. If you look into the fund fact sheet, you can find out more information about the fees. There could be something called a swap fee in addition to the ongoing charge, so sometimes you might have to look into these funds for some extra fees. I know Vanguard is quite transparent with their fees, and that's one of the reasons to why they are very popular. Here you can see the difference between the Invesco FTSE 100 and the FTSE 100 index in pounds, there are small differences between the two, but overall they do follow the same trend. Furthermore, the FTSE 100 is offered by iShares, a massive company owned by the BlackRock group. So we have the ISF, which is a distributing fund, so it gives out dividends, and I'm assuming that was going to be quarterly. So one difference you can see between this fund and the Vanguard fund is the fact that the total expense ratio is quite a bit cheaper at 0.07%. We can also see the fund price is a lot lower. Again, it doesn't mean you're going to get more in the future. However, with some platforms, you can only buy full amount of shares. You can buy a lot more in terms of ISF shares than a whole Vanguard FTSE 100 share. Platforms such as the one I'm using right now, InvestEngine, does allow you to invest with as little as £1, provided you meet the minimum deposit amounts. If we go into the breakdown of the companies, this is again very similar or almost identical to the Vanguard FTSE 100, with 139 holdings and AstraZeneca being the top. If we go into the key investor information pack, again, I know no one reads this, but essentially it is very similar to the Vanguard FTSE 100. They still use derivatives. It is not suitable for short-term investing. If you really wanted to, you can download InvestEngine and check out all the information of these funds at your own leisure. So in my opinion, if you really do want exposure of the FTSE 100, the iShares FTSE 100 offers a very compelling option with lower fees and a lower barrier to entry because the shares actually cost lower. So I realized whilst I'm editing that the ISF has a much lower dividend yield than the Vanguard FTSE 100. For that reason, I'd probably recommend just going with the VUKE. Even though there's higher fees overall, you're getting almost double the dividend yield. Furthermore, iShares also gives the FTSE 100 the CUKX. This is an accumulating fund with a very low fee of 0.07%. Again, almost the exact same way of measuring the index, with 139 holdings and AstraZeneca being at the top. Here we have the FTSE 100 income fund from Xtrackers, and this has the ticker code XUKX, which is very symmetrical and I like that. This fund is a distributing fund which focuses on income and has a total expense ratio of 0.09%. As you can see, very different from the normal FTSE 100 fund. This is not a very massively popular fund because it deviates from the popular just tracking the FTSE 100. It is more of a derivative of the FTSE 100. So for many investors, especially when they're closer to retirement, this could be a fund to put your money in and live off the dividend yield. Now, although this fund says income, it's not specifically tracking just income. It does track the FTSE 100 in the way that Xtrackers, which is the provider, wants to track it. So overall, I would say if you're going to invest in the FTSE 100, you might as well invest into one of the funds that have a lot more money going into them. This is because companies such as Vanguard and iShares have a lot of trust behind them, and if something does go wrong with Xtrackers, which is not as popular, there might be some time until you see your money again. And finally, even HSBC has their own FTSE 100 index, ticker code HUKX. As you can see, this is a distributing fund with a total expense ratio of 0.07%, so actually lower than Vanguard themselves. We can see that you have exposure to 146 companies, so very different from the Vanguard FTSE 100. In terms of region, again, 82% in the UK, 15% in Europe, and very small exposure to the rest of the world. In terms of sector, mining, healthcare, financial, and industrial reign supreme, with the rest being consumer, technology, property, energy, and other. Make sure to check out some of my other videos, and I will see you in the next video.